there's a very big gap. If you had been invested in the RSP, equal weighted index, you have vastly underperformed the markets by about 50%. Let's talk a little bit about what you need to know before the bell this morning. Little bit of data out this morning, not a lot. We've got housing numbers coming out, of course. National home builder sentiment has been dropping sharply, and particularly in the new home sales area, because those have been fairly weak. Also, initial claims out today. We're going to continue to see initial claims tick up. Again, concerns when it relates back to the Federal Reserve is whether or not unemployment is going to go up, which would get the Fed to cut rates. So everybody's watching initial claims today to see if those are going to be rising to any degree that would suggest that employment is actually weakening. One of the big dichotomies now, we're covering this in this weekend's newsletter, and we've talked about this over the last week or so, is about market breadth, right? So we've seen the number of stocks trading above their 50-day moving average. Those have been declining, even though the market's been rising. The number of stocks above their 200-day moving average are declining, even though the market is rising. One of the big gaps right now that's going on, and we haven't seen this big of a gap in performance since really the financial crisis back in 2008, is that between the S&P 500 and the equal weight index. So this is RSP, which is the ETF that represents the equal weighted index. And while the broad market continues to make new all-time highs, the S&P equal weight index has not really done much of anything really since April. We had this correction in April, just like happened with the S&P. Since then, has traded fairly flat because this whole rally since April has been pretty much just a handful of tech stocks that have been going higher. But this isn't just a recent level of underperformance. This really underperformance goes back to October of 2022. There's a very big gap. If you had been invested in the RSP, equal weighted index, you have vastly underperformed the markets by about 50% relative to what the market has returned itself. And that's because of the differential in weightings. The RSP, the equal weighted index, has about a 15% weight in technology. And in the top 10 holdings is not Apple, Nvidia, Microsoft. They don't even show up in the top 10 holdings. Of course, if we take a look at the SPY, which is the market cap weighted index, the top 10 holdings are Apple, Microsoft, Google, Nvidia, the ones that have been driving the market. But the S&P 500 has a 31% weight in technology. So again, since technology has been driving the market, and again, if we just take a look at XLK as an example, so this is the technology index of the market. You can see that since here's April, had that correction, and even though RSP has done nothing because they are underweighted technology, you can see that really the technology index has been doing all the work of lifting the broad market. That 31% weight in the SPY is what's driving those returns. So here's all your activity in the markets. But that deviation between the market cap and the equal weighted index does not last indefinitely. And eventually that performance will reverse. It's just a question of when and what causes it. But that's what you need to know before the bell this morning.